Hello, everyone, and thank you for joining us for another episode of the Financial Commute. I'm your host, Chris Galeski, joined by Wealth Advisor and partner Mike Rudow. Mike, thanks for joining us.
Pleasure to be here. Thanks for having me.
We were having a conversation around the different types of tax preference savings vehicles, whether it's health savings accounts, Roth IRAs, traditional IRAs, and the order of importance. And there's some misconceptions because people like to make an emotional decision when it comes to taxes. And there are some incredible tax benefits by some of these different accounts, but also some misconceptions and some, common themes that we see or mistakes that we see people make when it relates to what should I contribute to, how much, what's the order of operation. So we thought we'd have a conversation around the different types of vehicles, kind of our thoughts on the hierarchy of how you should prefer them, and then some common misunderstandings.
Yeah, no, and it's so relevant because I think so many of us have the opportunity to contribute to different accounts, but we don't know which ones we should be contributing to or in what order or how much. And so kind of just laying out the land to give a high level understanding of each account, and then giving an order of operation of how you should think of these things, of when you should be contributing to each after, what decisions you've already made to contribute.
Yeah. And so if you're in the accumulation phase of life and you're saving for yourself now to build a larger nest egg for the future, there are certain accounts that you really want to take advantage of when you're young versus older, right, whether you're a high income earner versus not. And so trying to break it down and simplify it for everyone. I think the one with the most amount of tax benefits, you kind of go through a triple, double, single kind of way to think about it. But the one that has triple tax savings is the health savings account. Yeah. So let's talk a little bit about what you mean by triple tax savings.
Yeah, so in a health savings account, you get a triple tax benefit. And you get that unlike any other account, right? So you get first on the contribution, you get a tax deduction. So anything that you put into the health savings account, you get to take off of your ordinary income for that year. Then you get tax-deferred growth, which is the second benefit, second tax savings. So any appreciation, any income that's making, it's deferred taxes. And then on the distribution, you could get tax-free distributions, just like a Roth, as long as it's qualified expenses, yeah, right? So anything that has to do with long-term care, any medical event. It's pretty expansive what an HSA will actually pay for.
Look, I love health savings accounts. Obviously, you can only get access to them if you're in a high deductible health plan. And a high deductible health plan isn't right for everybody. But if you're a really high income earner and you're making a lot of money, there are some real reasons why you'd want to choose a high deductible plan, save into the health savings account, invest it and let that money accumulate and grow. So that way you have a tax-free distribution account later on in retirement.
Yeah. And you're right. It's not necessarily for everybody, but if you are a high income earner, there's the benefit outweighs any negative of having a higher deductible. Yeah. Because there's no other account where you can get the same, triple tax benefit and have the ability to contribute and allow that to grow. So treating it as truly, part of retirement planning, it's such a value add.
So before we go into sort of the hierarchy and how we think about somebody should be contributing to each one of these accounts, let's talk about the ones that have like a double tax benefit.
So for the double tax benefit, you've got your traditional, right, 401k or IRA, and then you've got your Roth. So in a traditional, what you're going to do on any contribution that you're making into account, that's tax deductible, right? So that's going to offset ordinary income. Then it grows tax deferred, which is the second benefit. But then on distribution, you're going to pay taxes and you're going to pay ordinary income. So based on whatever tax bracket you are when you make that distribution. Yeah. On the other side of it, the Roth is a double benefit also. You're actually going to pay the taxes before you contribute the money into the plan. But now taxes are paid, money grows tax deferred, and then when you make the distribution, you're not paying any taxes. You already paid the tax on those dollars, and you're not paying any tax on the gains that you attributed in that fund. So,
and really, if you're contributing to a 401k that has a traditional or pre-tax option or a Roth option, you're really making a choice on where you think tax rates are today and where you think they might be for you in the future.
Right. You only win in a Roth, right, if you're paying less taxes today.
The same or less.
Right, the same or less. It's the same. It's really odd that you get the same, but yes, the same or less. than you would be in the future. And there's another, like a 529 is also a double tax benefit where you're contributing into the 529 with after-tax dollars for the most part. Some states will allow you to deduct state taxes. Then it grows tax-deferred, but then any qualified distributions that you have for educational expenses will be non-taxable.
And so the reason why 529 has that benefit is because it's limited to higher education or secondary school.
Right.
And so they're offering you the benefit of getting that tax deferred growth and tax-free withdrawal because you're putting after-tax money in. You lose some flexibility.
Absolutely.
But you're getting some benefit there.
Yeah, you are. I mean, there's usually some sort of drawback to any of these, right? If you're going to get a benefit somewhere, there's got to be a risk somewhere else, right? There's always risk-adjusted return in everything that we do. Similar to an HSA, there's no guarantee there. You could end up, if you need access to that money and you need to withdraw early, there could be a penalty. If you're not using it for qualified expenses and you get audited, you could be, incurring a tax. Right. So it's identifying, the risks of entering those accounts, and just having the knowledge to know, like, okay, what is the downfall if I needed access to that money before it's qualified.
Right. And if I don't have the right expense to basically properly offset that distribution.
Right.
And then you mentioned that there's, a strategy with a singular tax benefit. What are those?
So non-qualified annuities, right? Meaning that it's an annuity that's not purchased in an IRA or a tax-deferred account. With a non-qualified annuity, you are using after-tax dollars to put in. That gets to grow tax-deferred. Right, so you're not paying any tax on any of the income or gains that annuity is accruing. But then when you make the distributions, those are taxable distributions.
Yeah. Some portion of it are pro rata between contributions and earnings.
Anything that you already paid the taxes on the money going in, so that sets your basis.
Yeah.
And then anything above that, when you make the distributions, you're going to be paying gains.
So as we think about the hierarchy in terms of how somebody should be thinking about contributing to some of these accounts. You've got, the 401k, whether it's pre-tax or Roth. You've got the health savings account. You potentially have, 529 if you're saving for your kids' education like we are. You've got your traditional brokerage account because you want to build up a nest egg so that way you can, buy a house or do other things. There's a lot of decisions somebody needs to make as they're in the accumulation phase. How would you go about determining which accounts to contribute to first? All the way to last.
Yeah. And so there's no one right answer to that, right? It's important to have a plan set out, to understand what you're trying to accomplish, and then create that plan based on those goals. But from a high level, the best hierarchy is, one, you shouldn't be investing anything if you don't have an emergency fund set up, right? So make sure you have money set aside. And normally if you're a single income household, that's at least 6 months of non-discretionary spending. If you're a dual income household, that could be 3 to 6 months of cash set aside. But if you're entrepreneurial or if you're an extremely high income earner, that might not be enough, because if you lose your job and you're an extremely high income earner, it might be hard to replace that. So even knowing the scenario, or if you're entrepreneurial and you might want to start a business, people like that maybe have 12 to 18 months of cash set aside, and it could be put in a money market. It doesn't have to just sit in cash. It could still be accruing interest.
I think about those real estate agents that went through that financial crisis. I mean, it was a couple years before mortgage brokers, real estate agents probably made the type of income they were prior to.
So understand your scenario, right? And then understand what you're comfortable with as far as an emergency savings where you're not going to be stressed. Because, there's statistics that show people that have more cash are happier people. Mm-hmm. And it's because they're not stressed day to day. If something were to happen, they know they've got a backup plan. So first, establish that, emergency fund. Then we can start looking at investing, and that's if you're in a qualified plan, a company-sponsored plan that provides a match. Because the first thing you're going to want to do is get free money. So maximize whatever employer contributions or employer match that you can.
Yeah.
So say you work for a company as a 401k, they match 3%. You're doing at least a 3% contribution, so they're going to match 1% on 1% for that.
Yeah.
Now, once you've maximized the employer match, you don't want to go on investing more until you've identified your debt. So now we're going to look at your high interest debt. If you've got a lot of credit card debt that you're paying 18, 20% on, you shouldn't be investing money until you've paid that off. So the next order or object in line is it would be paying off high interest debt.
And you would quantify that as any debt where you're paying a higher interest rate above 7, 8, or 9%.
Yeah, if you're
what you're likely to get from returns from investment.
Yeah, if you're looking at a traditional portfolio, annualized returns over a long period of time, if you're paying over 7% debt, you should pay that debt off. You should pay that debt off first, and then be able to invest any discretionary money that you have.
So that's helpful to think about. Right? I want to make sure I have an emergency fund to take care of my needs. I then don't want to give up on free money. And then I want to make sure that, I'm not paying any high interest debt and wasting money from there. Let's say money's left over from that. How would I go about thinking about what's next?
So now you want to maximize contributions to either that company plan that you're in. If you're a business owner, it could be a SEP, an I-401k. But you also want to look at your HSA contributions in the same bucket. Now, so if you do have the ability and you're a high income earner and you've got a high deductible plan, now you're balancing, okay, I should max out my HSA and I should max out the contributions to any employer-sponsored plan, or if you're self-employed or non-employed, right? There's IRAs and other options there.
Now, there's limits for you to be able to contribute to like a Roth IRA directly. And so if you make over $146,000 as a single or $230,000 married, filing joint, it may limit your ability to access and contribute directly to a Roth IRA, but not a Roth 401k.
Right. In a Roth 401k, there's no income limit because it's a company-sponsored plan.
Yeah. And I struggle with this one because we don't really know where tax rates are going to be in the future. But if you're a very high income earner, you could justify the reasons for a tax benefit today. So do the traditional, the pre-tax, but it shouldn't just be one or the other. I strongly feel that maybe people should be building up both buckets. I mean, if you're young and your income's low, maybe put more of a higher percentage to the Roth 401k portion.
Yeah.
But,
I
adjusting
agree with
it.
that. I think people look at it as a zero-sum game a lot, where they think, I either should invest in a traditional or a Roth, when in reality, there's no reason you can't put 50-50 and build both buckets so you have better tax planning and better tax strategy when you do get to retirement because you got multiple buckets to pull from. But if you are in the highest tax bracket right now, it's pretty beneficial to be able to use that traditional, whether it's a 401k or IRA, and not pay that 30 plus percent on those dollars today, knowing that most likely you're going to be, now it's not guaranteed and who knows where taxes are going to be in the future, but most likely when you're retired and you don't have earned income, you're going to be in a lower tax bracket. Yeah. But that doesn't mean you put all your eggs in one basket. Like, identify opportunity to build that Roth but take advantage, especially if you're in the top tax brackets, take advantage of that tax savings.
Yeah, I especially think about how expensive it is these days to purchase a home or to raise kids. You're going to need somewhat of that tax break to be able to save additional dollars, to be able to fund a 529, to be able to save for a down payment on a home.
Well, that's why you got to deviate from, that hierarchy every now and then, because it's all dependent on what's most important, to you in your life right now. If the most important thing is getting into a new home because you've outgrown your home, your family's growing, well, then you're not going to be you don't want to lock up your money into tax-deferred accounts because you're going to get penalized if you try to access those for the most part. There's a little bit that you could pull out in a 401k for a first home and so forth, but you don't want to even put yourself in that situation. So identifying your goals first, and then getting through, you've got your emergency account, you've maximized the employer match, you've paid off your debt. Well, now maybe it's not contributing more to your retirement plans. Maybe now it's building up a brokerage account that you're putting in safe money because in 3 to 5 years you're going to need that down payment for the next house. But that's where the planning is important.
And that's where you're weighing the sacrifice of saying, hey, by not contributing as much to my retirement today, I might have to work for an extra few years in the future, but at least I'm saving enough so that way I can, buy that home and have a place.
Yeah, and there's also that, theory where buying that home, you're now going to get appreciation in real estate over the long run where you're still building wealth. And, it's you're not paying, taxes on the appreciation of that growth. So there is some tax-deferred growth there in the appreciation of that asset. You are paying property taxes and things every year,
I've seen a number of articles recently that was talking about that whole FIRE movement, the financial independence, retire early. And this is where people save, upwards of 80% of their income today, so that way they can walk away from a job and enjoy retirement. But what some of these articles have pointed out is the life events and the experiences that they're foregoing with their spouses and their families today, just so they could retire early. Some of them said, hey, that's not worth it. I'd rather build a career, be able to enjoy my life a little bit more today, as opposed to have to sacrifice so much just so I could walk away from a job, at 50 versus 60.
You're taking away a lot of your options if you're planning on taking that route to an early retirement, because you're also setting yourself up for a very limited retirement experience where you're going to be on a budget the whole time you're retired, right? And there's nothing wrong with that for some people, but it eliminates optionality. It eliminates freedoms that, if you just are established in a career and you're balanced in putting away money for your future, but enjoying today and getting those memories and experiences today that you're never going to get back, because we're only, this old once.
Well, I think the one reason why a lot of those articles have been coming up recently is because just over the last few years, inflation has really, become a headwind for many people. And the ones that sort of were on this path for financial independence, retire early, they realized that even though they saved enough at the time to retire, inflation has now caused them to rethink that and say, oh, wow, I need to go back to the workforce and save more, because inflation could be the one factor that I didn't properly plan for.
Yeah.
So when you're talking about planning, obviously you talked a little bit about the short term, making sure there's an emergency fund, getting rid of short-term debt, taking advantage of accessing free money through company match and 401ks. How do you weigh the balance between that goal of owning a home in the next 5 years versus saving towards retirement, which might be 25 or 30 years away?
That's a tough question, because it's all based on individual preference and what's right for that in particular, person or family. Yep. But I think having a balanced approach helps, where you're not doing all in one bucket, where if you know that you want to get into a house, then you start putting away, 60% of your discretionary income into that bucket, but you're still able to start to slowly build up the retirement plan, so that you don't just put everything, you're still getting tax-deferred growth in the retirement accounts. You're still working towards your overall retirement goals, maybe not contributing as much as you could have, but you're attacking both buckets as opposed to all or not.
Which is some of the common mistakes that you and I talk about people do. It's just that singular focus. It's sort of an all or nothing mentality. But the reality of life is that life comes with a lot of sacrifice. If you want something in life, you're going to have to sacrifice something else in order to do it and deal with those consequences. Yeah. And those consequences aren't necessarily bad. It's just part of life.
No, and it just means that could be fine, that you're putting away more for now, but then you're going to have to play catch up later. And having that realization, knowing that you're going to have to work hard to put away more to get caught up to where you need to be, as long as you're aware of it and you plan for that, and you emotionally, that's something you're going to deal with because you made that sacrifice now. That's the important part about having a relationship with a financial planner or an investment advisor to help identify these things and help walk. These are emotional decisions that can be really impactful.
Yeah, and look, the money that we're saving and we're investing, it's tied to something that we have emotionally that we want to eventually do with that money. So that money comes with a purpose. We're not an institution that's trying to live on forever, that's not emotionally tied to the dollars that we see in an account. So we have to come to the realization that our emotions are going to affect these things, but creating a plan, having the right strategy, and customizing it for you, and not just doing whatever your friend is doing, probably makes the most sense. Yeah. What are some other common mistakes, if you can think of that people might make when it comes towards saving in one of the vehicles, whether it's a 401k, HSA, brokerage account? What are some other common mistakes that you see people make?
We've identified a few of them, right, where I feel like there's a lot of high income earners that don't take advantage of an HSA because they don't want to be in a high deductible plan. And you don't have to be a high income earner to take advantage of an HSA, but I see it more with high income earners where they're thinking, why would I want to go into a high deductible plan where I've got an employer that's offering this great plan with these low deductibles where I know I don't have to come out of pocket, And so it's sitting down and getting them to really understand the power of that HSA and being able to, accumulate wealth in that bucket where they want to have opportunity. Another one, it comes down to the Roth. There's a lot of high income earners too that assume that because they have the ability to put into a Roth IRA or a Roth 401k, because there are no limits on income in that account, that they should. And I see people who are in the highest tax bracket now that are putting into the Roth and not taking any benefit of being able to reduce their taxable income now. So, and I'm not saying there's one right answer to it, but it's at least worth having the conversation and not being so dogmatic and, this is what I should do because this is my scenario.
Yeah. Because the reality of that is if you're making $750,000 $1 million a year and you're in the highest tax bracket, well, that's assuming you're going to be making $750,000 or $1 million a year in retirement and that tax rates haven't changed at all.
Right.
But if a lot of your money is now in this Roth account that's tax-free when you take it out, your incomes might not be as high.
Right. Yeah, and that's why, but I think that there's a balance there where you should understand what tax benefit do I want now and what tax benefit do I want later.
Yeah. I love that. I know we talked a little bit about the different types of an account and what's available to you, but really making sure that you've got that emergency fund, you're taking advantage of free money, you're in an HSA account, but actually contributing to it. You don't want to be in a high deductible plan and not be contributing to the HSA. Then determining about, taking care of high interest rate debt and saving for your current needs in the next few years through a brokerage account versus your long term. All of this comes back to having a personalized plan for you, which is something that we're happy to sit down and talk to anybody about.
Yeah, absolutely. And, it's what's so fun about our job is not having, one answer for every problem. Every relationship that comes in here, every family that we get to work with, we get to develop a unique solution set.
I love the fact that we work in this industry, not only because it helps me be more knowledgeable about the ways to take advantage of some of these things, but I wish our clients and our friends and family could hear how much we actually talk about the problems that we're trying to solve for each other day in, day out. And so it's nice to have great resources. Mike, thank you so much.
No, this has been a pleasure. Thanks for having me on.